The evidence accumulating across multiple federal districts represents more than prosecutorial ambition or political retribution. It represents a fundamental recalibration of how markets will price institutional risk in democratic systems where legal constraints theoretically apply universally. I measure this development not through the lens of electoral politics or ideological preference, but through the patient capital allocation framework that has guided my investment decisions across 7 decades of watching institutional frameworks either strengthen through adversity or deteriorate under pressure from concentrated interests that mistake temporary influence for permanent immunity. What concerns me most profoundly about this institutional moment is not the fate of individual political actors, but the precedent being established for how sustainable wealth creation relates to systematic rule enforcement in the world's primary reserve currency jurisdiction. Markets reward patience and punish institutional uncertainty with mathematical precision. And the cost of that punishment compounds over time in ways that permanently alter the competitive landscape for capital formation, technology development, and long-term economic growth across entire civilizational systems that depend on predictable legal frameworks for complex value creation. The cascade of legal determinations, asset freezes, and prosecutorial immunity grants that have accelerated throughout this period represents not temporary political turbulence, but permanent recalibration of systemic risk premiums that will affect how international capital evaluates American institutional durability for generations. When federal judges document systematic fraud spanning multiple decades, when congressional committees invoke emergency procedures to address constitutional violations, when prosecutorial resources are allocated toward cases involving bank fraud and tax evasion by former executive branch officials, we are witnessing the slow-motion activation of accountability mechanisms specifically designed to prevent the concentration of wealth and power from undermining the legal frameworks that enable complex economic systems to function efficiently. I have spent 7 decades watching capital compound in environments where institutional predictability creates sustainable competitive advantages, and I have watched equivalent fortunes evaporate where that predictability deteriorates due to the emergence of dual-tier systems where legal constraints apply selectively based on political influence, media attention, or accumulated wealth. The Deutsche Bank documents, the congressional testimony requirements, the federal asset freezes, the immunity grants to cooperating witnesses. These developments follow the predictable trajectory of major institutional recalibrations, but their implications extend far beyond individual accountability toward fundamental questions about whether democratic capitalism can maintain its institutional advantages over alternative systems that explicitly prioritize political relationships over legal consistency. The systematic pattern emerging across these proceedings reveals something more significant than prosecutorial coordination or political targeting. It reveals the activation of constitutional mechanisms specifically designed to constrain executive power when that power claims supremacy over fiscal limitations, judicial determinations, and congressional oversight explicitly enumerated in foundational governing documents. The emergency congressional sessions, the judicial language characterizing constitutional violations as flagrant and indefensible, the prosecutorial focus on systematic misrepresentation spanning multiple decades, these developments represent the institutional immune system responding to sustained attempts to operate above legal frameworks that have protected property rights, contract enforcement, and capital security since the founding of this jurisdiction. I observe how different categories of institutional capital respond to this constitutional stress test, and the patterns confirm theoretical frameworks I've applied throughout my career for evaluating systematic risk in complex organizations. Short-term political capital rushes toward defensive positions, seeking immediate protection from exposure through legal challenges, media campaigns, and alliance building designed to delay rather than resolve fundamental accountability questions. Medium-term business capital begins hedging against regulatory uncertainty and reputational contamination through protective contractual clauses, increased insurance premiums, and strategic distance from entities under federal investigation. But long-term institutional capital, the patient money that builds infrastructure, funds technological development, and creates sustainable competitive advantages across multi-decade time horizons, begins quietly repositioning toward jurisdictions where legal frameworks demonstrate consistent enforcement regardless of political pressure, media narrative, or accumulated influence. This repositioning happens gradually and without public announcement, but its cumulative effect on borrowing costs, investment flows, and innovation capacity becomes measurable over extended periods, particularly when international investors begin factoring institutional uncertainty into their risk models for what has historically been considered the world's most stable investment environment. The congressional emergency sessions addressing constitutional violations represent something more strategically significant than legislative theater or partisan maneuvering. They represent real-time testing of whether separation of powers mechanisms can function effectively when executive authority explicitly claims supremacy over fiscal constraints, judicial determinations, and congressional oversight clearly delineated in constitutional text. The market implications of this institutional test extend beyond immediate political outcomes because they establish precedents for how future conflicts between branches of government will be resolved, how constitutional limitations will be enforced, and whether legal frameworks can constrain concentrated power when that power mobilizes significant resources to avoid accountability. If emergency congressional procedures can produce meaningful constraint on executive overreach, institutional premiums for American assets remain justified based on demonstrated capacity for self-correction through constitutional mechanisms. If they cannot, if political pressure successfully prevents constitutional enforcement despite clear textual violations, the precedent establishes that constitutional constraints are effectively optional for actors with sufficient political influence, which fundamentally alters risk-return calculations for patient capital deployment in jurisdictions where legal predictability has historically commanded premium valuations from international investors. I calculate three primary scenarios emerging from current institutional dynamics, each with distinctly different implications for long-term capital preservation and wealth creation capacity across the American economic system. The first scenario involves successful institutional constraint, meaningful accountability for constitutional violations, and clear demonstration that legal frameworks can withstand concentrated pressure while maintaining equal application across all actors regardless of political position or accumulated influence. This outcome would actually strengthen institutional premiums by proving that democratic mechanisms can self-correct when tested by systematic attempts to operate above legal constraints. The second scenario involves institutional failure, selective enforcement that protects politically connected actors despite overwhelming evidence of legal violations, and the establishment of explicit dual-tier systems where constitutional constraints apply differentially based on wealth concentration, political influence, or media support. This outcome would gradually erode international confidence in American institutional fairness and trigger systematic increases in risk premiums for assets located in jurisdictions where legal enforcement appears increasingly politicized rather than consistently applied according to evidence and constitutional text. The third scenario, which I consider most probable based on historical patterns of institutional stress and political pressure, involves partial accountability that demonstrates basic constitutional functionality while revealing practical limitations in how effectively legal frameworks can constrain highly motivated actors with significant resources, political protection, and media influence. Under this mixed scenario, institutional premiums would moderate rather than collapse, but the long-term trajectory would favor gradual increases in compliance costs, defensive legal strategies, and capital allocation toward jurisdictions with more predictable enforcement patterns and less political interference in judicial proceedings. I observe how international capital markets have already begun factoring these institutional uncertainties into their risk assessment frameworks, and the adjustments follow patterns I have studied across multiple jurisdictions during periods of institutional transition. European banking regulators are quietly reviewing their exposure to American real estate assets tied to entities under federal investigation, not because they expect immediate default, but because they must account for increased regulatory uncertainty in their risk models. Asian sovereign wealth funds are expanding their due diligence requirements for American investment targets, incorporating political risk assessments that previously applied only to emerging market investments. Global insurance markets are reassessing their political risk premiums for assets located in jurisdictions where legal enforcement appears influenced by political considerations rather than consistent application of written law. These adjustments happen incrementally and without public announcement, but their cumulative effect on capital costs and investment flows becomes measurable over multi-year time horizons, particularly when they establish precedents that influence how similar institutional stress tests are handled in future political cycles. The freeze of multiple billions in assets represents more than individual financial pressure or prosecutorial theater. It represents demonstration of state capacity to constrain concentrated wealth when that wealth appears to have been accumulated through systematic misrepresentation to financial institutions and tax authorities. International markets need to observe this capacity demonstrated periodically to maintain confidence that property rights are protected through legal frameworks rather than political relationships, and that accumulated wealth cannot simply purchase immunity from legal accountability when evidence demonstrates systematic violations of fraud statutes. Yet when asset freezes are successfully implemented and sustained despite significant political pressure and media campaigns, institutional confidence in legal consistency increases because the mechanism proves functional under stress. When they are reversed through political intervention rather than legal process, confidence deteriorates because the precedent suggests that sufficient political influence can override judicial determinations based on documented evidence, which fundamentally changes how international capital evaluates systematic risk in democratic jurisdictions. I measure the compounding effects of institutional decay through multiple indicators that extend well beyond immediate legal outcomes or political consequences. Credit markets begin incorporating political risk premiums that historically applied only to jurisdictions with weak legal institutions or inconsistent property right enforcement. Insurance markets begin treating reputational exposure as a separate category of measurable risk requiring additional premium collection. International business relationships begin including protective clauses against regulatory complications or legal entanglements that might arise from association with entities under federal investigation for systematic fraud. These adjustments appear minor when evaluated individually, but their aggregate effect on capital efficiency becomes substantial over extended time horizons, particularly when they establish precedents that influence how similar institutional challenges are priced by market participants in future cycles. The involvement of family members in federal testimony creates particularly complex institutional dynamics because it tests whether legal frameworks can maintain prosecutorial independence when personal relationships intersect with potential criminal exposure involving former executive branch officials. I observed this development not as human interest narrative, but as systematic evaluation of whether prosecutorial institutions can withstand emotional and political pressure that inevitably accompanies investigations extending into family systems of prominent political figures. The capacity to maintain prosecutorial focus despite these pressures demonstrates institutional maturity and strengthens international confidence in legal consistency. Failure to maintain focus suggests that personal relationships can effectively shield criminal behavior from accountability, which establishes precedents that fundamentally alter how markets price legal risk for politically connected individuals and their business enterprises. The emergency congressional sessions addressing constitutional violations represent activation of institutional mechanisms specifically designed to address executive overreach, and their effectiveness will establish precedents for how similar institutional challenges are resolved when constitutional text explicitly prohibits executive actions that redirect congressional appropriations without legislative authorization. I calculate long-term institutional implications based not on immediate political outcomes, but on whether these mechanisms prove capable of constraining executive power when that power explicitly claims supremacy over constitutional limitations clearly enumerated in founding documents. Successful constitutional constraint demonstrates that institutional frameworks retain functional capacity under political pressure and justifies continued institutional premiums for assets located in jurisdictions where legal predictability commands international confidence. Unsuccessful constraint suggests that constitutional mechanisms become effectively optional when challenged by sufficient political pressure, which requires fundamental reassessment of American institutional durability and systematic increases in risk premiums for long-term capital deployment in democratic systems, where legal constraints appear increasingly subject to political negotiation rather than consistent enforcement. Markets reward patience, history punishes institutional denial, and time always collects compound interest on systematic risk that accumulates when legal frameworks fail to constrain concentrated power effectively. The current institutional stress test will resolve, according to evidence, constitutional capacity and prosecutorial independence rather than political preference, media narrative, or electoral calculation, and that resolution will establish precedents influencing international capital allocation decisions across multiple decades of future economic development and technological innovation. I position for institutional durability while maintaining systematic awareness that democratic systems under sustained pressure can experience rapid institutional failure when their foundational assumptions about legal equality and constitutional constraint prove inadequate to constrain concentrated wealth and political influence, and the compound cost of institutional collapse exceeds, by orders of magnitude, the cost of institutional preservation through consistent legal enforcement, regardless of political inconvenience or short-term economic disruption.